Tim, welcome back.
Good to see you guys. Happy Monday to you.
Look at those. You got to get a little shimmy when you get the market
shiny, happy people. That's right. Yeah.
Where are you today, Tim?
I am, as you might be able to tell.
Steamboat, come on.
I'm in
beautiful background.
I've seen it before. I didn't even know a steamboat.
And if you look over, you can see a little flicker just over my, I don't know, but to me it would be over my left shoulder. I guess to you it would be right. See that little flicker of flame? I've got the fire pit on out there on the on the patio.
The cool down. The cool down's coming.
My phone says it's 43.
Ooh. Oh gosh.
Yeah. I miss the weather. I miss that weather too.
Yeah, I'm 45 buying that low.
I'm 45
We're buying the low. We're saying it's going higher here today.
Yeah.
I'm saying the temperature's going up. Me and Joel are along
the algo's already hit.
45 bid. I'll sell some at 50.
I'll say the action there is fast trading. That's fast trading action.
We're all over everything. Joel and I watch a baseball game and we're like just talking the averages and where it's going to go.
That's been a while.
That's been a while.
All right, Tim, what's going on? Give us some market structure here. We had the options expiration before I left, and the market, it held in there till Friday. The old sneaky Friday, almost get near the high and then finish near the low. So any positives out there first coming out of you? We could talk about the negatives, but any positives you could see from the retreat last week?
Well, I don't know if I would look at I wouldn't look for positives per se. I would look for things to trade. So, and there are things to trade.
Well, I like that.
There always are, right? So to me, I don't prefer to trade during options expirations, but supply and demand gives some signal, then we'll use those. How can you look at the market from a positive negative perspective right now? I don't know. I saw on CNBC Squawk Box. Not that I would watch that. That Joe,
I like that.
that Joe Kernan and Mohammed Al-Arian have a bet that will result in going to some sports event on whether the market breaks through 3,600. I don't know. I don't watch those kind of things.
Mohammed on the bearish side?
He's actually on the bullish side.
Yeah, he got on the bullish side. I saw him.
I'm scared. Mohammed's good.
Yeah,
he said 4,400 is his target for year end.
Really?
So, yeah.
So he's on there right now. Actually, look at this, Mohammed.
Yeah. So we'll see.
Good today.
yeah.
I'll take that.
I always enjoy what he has to say. Well, to me the thing to think about is there something that the market will do that will tell us how it will respond to something that the U.S. Federal Reserve does, and I put that qualifier in there for you, Dennis, because there's because you're a Canadian, so I have to put a qualifier in there. But will the market tell you what to expect? Why does the market go up sometimes when Jay Powell speaks and go down sometimes when Jay Powell speaks? And people will say, well, we're expecting a Fed pivot, and that didn't happen, and so the market falls dramatically. I'm sure there are certain elements of that. I think it's very important for traders to understand that it's not rational thought that leads to that. It's people's bets. Yeah. Now, rational people don't destroy their own holdings by 1,000 Dow points in response to Jay Powell. That's not the way rational people behave. Let's demolish our retirement accounts. It's not how investors behave, but there can be bets. To me, the good news is that the data will generally show you what's coming. And Joel, that's my answer. My answer is are there positives and negatives? Well, the positive is generally you can see in the data what's going to happen. Not perfectly. I mean, I couldn't tell you perfectly that Friday would be the down day, but we certainly were telling people that ahead of August 31, when index futures expire, what you want to watch is the supply-demand balance in the market into about T+2 to T+3. That's trade day plus a couple of 2 to 3 additional days for settlement. Now, the official window is T+2 traders. So that is, if you're big institutions and your aim is by the end of the day on August 31st to have cleared positions and moved things, then you would do it today at the very latest, and maybe Friday, just to be safe in case there are some difficult elements in there. So we said, well, there's risk. Remember that when I was on Monday, we talked and I said, well, the Dow could go down 500 points today. It did, right? How is that? How is it possible to know that? Well, new options traded that day, and we could see that demand was down about 2% last week. So 2% would be roughly 500 to 600 Dow points. Son of a gun, that was pretty good, right? I didn't expect that the market would fall apart from there because the demand curve has been very slow in declining. So that tends to tell us what to expect. And traders, maybe I'll show you what I mean by that. And there is an important, I think, and there's a economic point to make here, and I don't want to forget to do that because I think that there's symmetry between economics and how the stock market works. And so I don't want to get away from that point, but I do want to show you this. So here is, I think you can see this. Here is market structure edge. So this is what I mean by supply and demand. Here's the broad market, and here's this see this green part of the graph? That is demand. It's just an algorithm. It's no different than the models that the Fed runs to try to understand, well, what's the economy doing? Well, they have models they run and data inputs. Well, we have models we run and data inputs to assess the supply-demand balance in the stock market. There's a difference between the stock market and what the Fed does, however, and it's a great lesson. The rules of the stock market provide a fulcrum because everything that happens in the US national market system, I will distinguish that from over-the-counter stocks, which are a whole different beast, and in some ways a much more free market than is the national market system. But the rules provide a fulcrum. So there's a fulcrum and a teeter-totter called supply and demand. Well, the economy is the same way. The currency, the dollar, is supposed to be the fulcrum upon which we assess supply and demand because people put people and money, labor and capital, businesses put people and money to work to make stuff. That's labor and capital. If the currency is stable, we can determine how much money and how much labor to put to work to produce something and how to price it and what the curves are. Well, if you constantly move the fulcrum to try to balance out supply and demand, over time it will become very difficult for businesses to determine how much money and how much labor to put to work to make things. This is why we have these incredible boom-bust cycles. And the interesting thing, and then I'll shut up on this subject, is that in the US Constitution, in the one sentence that articulates the ways that the US government can carry out the specific ways that the government can carry out its general responsibility to promote the general welfare is fixing the rate of exchange of the US dollar. It's right there. You can read it in Article 1, Section 8. So if the Fed did that, we wouldn't have this trouble. You could earn a decent interest rate on your savings. Businesses like mine could determine what is our cost. I mean, we're doing a very careful analysis right now because of the pressure that's beginning to mount on consumption. The Fed should not be trying to change the labor side of the equation or the capital side of the equation because that's our job as businesses and consumers. And to say, well, we want to slow consumption is asinine. Our economy is built on consumption. 72% of US GDP comes from things we do as consumers. So if the Fed tries to slow that down, it's wrecking the economy. There's only one thing it can do to address inflation: fix the rate of exchange. Then we can figure it out from there. So now back to this data. That's how the stock market works too. The fortunate thing is the fulcrum doesn't move. So we can see supply and demand more clearly in the stock market. So when demand begins to tail off right after options expirations, that's those three green squares, and the supply side is skyrocketing, what will the market do? It will tip over. It's not complicated to figure out. So you could know that before Jay Powell speaks. If you see that happening, we'll just step aside and let the market do its thing. And then you want to find, well, where's the money going? And so here's one difference I would have, Dennis, with I heard your comments about XLM and energy. I want to show you the supply demand curves across the market. Broad sentiment's at 5.7. It's not below 5 yet. There's still a little excess demand. If we tip below 5, then we have real trouble. And I'm not saying that's going to happen, but let's look at airlines and cruise ships. Demand imploded, supply is fairly level. I've got stuff in our program here, very strong demand, falling supply, and I've got both. I'll show you a short we should do. Building materials, collapsing demand, rising supply. Well, it's not good. You can go all the way through the market. Let's look at tech. Let's look at tech, because tech's the bellwether. Well, collapsing demand, rising supply. Industrials, which have outperformed, collapsing demand, rising supply. Don't want to be in any of those. But I would take energy because it's got steady demand and now the supply is above trend. That's why the prices have slowed down, but it is tipping down. So that's the first place I would look for things that would outperform the market. And I could go down to say, well, I like to trade volatility. So I look at now there are only 3 volatile 10s left. That trade's breaking down. But if I look at them, guess what they are? They are all energy stocks. And they all move about 5% a day. I own Laredo. And I don't usually own something through a Jay Powell speech. But I kept Laredo because I was up in it. It was the whole market's down, I'm up. It's it depends on where you buy it. Right. So LPI, AR, EQT is the worst of the 3, but all of those are reasonable trades that could, if any of them are down 2-3%, you could probably make 2-3% because they're very likely to rise at least that amount. So if I looked at the whole market, I guess that brings us full circle, Joel. I would still say energy, despite a strong dollar, gives us the best supply demand equation. Now my window, I only look 3, 4, 5, 6 days out. Then everything could change. But at the moment, that's the place to be.
There's still strength and energy here at the moment.
Yep.
Right now.
Yep.
I'm probably early again here, Tim. I'm always early.
Well,
I'm one that's always like 3-4 days early. You'll probably get this rip roar, and Tim will be right. They'll go up for 3-4 days, and then then the collapse will happen. So.
Well, let's look at XLM. I mean, you're not wrong about XLM from a supply side issue because the supply has risen above the trend, but the demand side is still pretty good. It's going to be a non-linear return.
It kind of looks like it's converging, though.
Well, see, the green part is demand. This is price. So price fell on Friday, but the demand side rose and the supply side fell.
By the dippers.
So exactly, because I think you could make, now XLM is not a volatile stock, but you might ride out a dip in the market buying XLM because it might go up 1.5% and the market does the opposite. Well, that's a 3% return, right? In a sense, if you're out of the S&P 500 and you're in XLM, I like those kind of trades. I traded ED last week because it moved opposite the market. I like a big and stable when it's and then a volatile stock. I kind of pair those things, and generally you can produce a return that way.
All right, so this is kind of more of a, I don't know if this is specifically a long idea, but definitely a long area that you can be watching right now. Now, what's a short area or short idea that we can be looking for?
So let me ask you, what if long is diverging supply and demand, what would be short? Not a trick question.
The opposite. So
exactly right. That's exactly right, Mitch. Mitch. It's converging.
Got my star today. Don't worry.
Right. So you want to find something with converging supply and demand, such as, I'm not knocking Granger. It's just that they've had they have a huge demand. In fact, there are three trading lessons right here in this single chart for you traders who trade supply and demand. But here's why it's a short. Demand, the green part of the graph, the gray is the price, closing price, is plunging and supply is rising. What is the probability that GWW declines? Well, very high, right? It's not perfect and it might not be linear, but that's the kind of thing that's very likely to produce a decline. The opposite. So you could trade one short and one long, you might double your returns. I'm just saying it's something you can do. And look, you could trade just Granger. When demand hit 10, right here at August 1, and supply is way below trend, buy it. And then when supply jumps above trend, about at options expirations, August options expirations, leave. Now you can go short. Buy, leave, short. And you can do all of that in 1 month and produce a very nice return. I'm not
How
saying it works
often,
perfectly.
Tim, do you reverse your trade? This is such a good conversation, and there's so many traders, and I've struggled with it too. You know, you're in a good long, and you're like, oh, it's coming up, 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 and I'm like, boom, you know, and you get out, and you're feeling great about it. Well, if you're really feeling great about that sale, why not go short it too, and take it on the other side? Calling reversing your trade completely. Joel's good at that too.
It's hard. It's hard.
It's a hard thing to do. How often do you do reverse the trades, like where you just turn around and you actually go from long, sell, short, all in the same boom execution?
I need to learn from you, Joel. I don't know. So I know the long side very well. I would describe myself as an expert in supply demand data like this, but I'm going short. I don't have enough time in the saddle. So I'm queasy about it, Dennis. I have a very hard time doing something like that. Now there are edge users who send me notes all the time like, whoa, that was a great short. And I've not gotten there. It's on my list of things to learn because I think we could double our returns by being very good at that. So Joel, we're going to have to learn from you.
Market goes up most of the time, Tim. So
it does, right?
Dennis, you do your with the reversals too. I mean, I that's one thing.
Try to do it. It's tough sometimes.
Yeah,
too.
You try. It is because then you also have the regret, like, oh, I sold it. It's still going up. Now I'm short.
Now you're short. Now you're losing.
Yeah.
You're totally fighting the momentum when you're doing that too.
Yeah.
So it's a tough trade.
It's tough.
Well, that's where I think context can help traders. Always beware. To me, I think you should always be aware of the 3 points in the month. New month, new money. Money will come in. People are putting money to work every month in their retirement accounts. That has to get deployed. It's the law. You can't sit around if you're a fiduciary who says in your prospectus that I do the following with somebody's money. You're going to have to put it to work. Now, if people stop putting money into the market, we're going to see that across the broad market by seeing falling broad demand. But they're going to do that. Then at options expirations, all the bettors, all the people using substitutes in the form of options and futures, they're going to true that up. Well, then you should know that. And then month end, people true up as well. So if you're going to go long or short, think about that. Think about what is happening at those junctures, and I think it improves your probability. Now, that's coming from somebody who's lousy at shorting, but I think it's something to keep in mind.
Well, definitely, guys, and don't forget, like always, you guys can keep up with this data. Just go ahead and check out Market Structure Edge, check it on out, and you guys can do the same thing that Tim Quas is doing here. He's just going with the data, just like the Fed, right? Data dependent. Just
like the Fed. Yeah. I hope we're a lot more accurate than the Fed. The Fed is just miserably inaccurate,
Yeah, I'll put my bet on you, Tim. Don't worry about it. Let's go ahead. We're going to wrap up. We'll have you next week. Appreciate you, Tim.